a single product named T140. The following Now allow me to move to the next part of the question, which is on CVP. CVP. Let's move to the next part of the question. Part C of the question reads, Tinga Limited manufactures and sells a single product named T140. The following information relates to the product. Selling price per unit is 180. Variable cost per unit is 80 shillings. Fixed cost per annum 5 million. Required Roman 1, break-even point in shillings and in units for marks. Roman 2, the total number of units, the number of units to be produced to earn a profit of 1.2 million. That is the question. We need to calculate, first of all, the break-even point in units, then the break-even point in shillings. So this is part C. We are to calculate the break-even point in units. To calculate the break-even point in units, we know the formula is fixed cost over contribution margin. Just fixed cost over contribution margin. So what is the fixed cost in this question? 5 million. The fixed cost here is 5 million shillings. What is the contribution margin? We know the contribution is equal to selling price minus variable cost. Contribution margin is equal to selling price minus variable cost. The selling price here is 180. The variable cost from the question is 80. So that will give us the break-even point in units. This will be equal to 5 million divide 180 minus 80 is just 100. It's just 100. This is equal to 50,000 units. Now this is the break-even point in units. That means that if the company is to produce 50,000 units, the company will not make any profit, because at break-even point, profit is equal to 0, which means that the total cost equal the total revenue. At break-even point, total revenue is equal to total cost, and we know profit is equal to total revenue minus total cost. So total profit is equal to revenue minus the cost, which will be equal to 0. If the company produces 50,000 units, there is no profit at this point. This is the break-even point. The first shilling of profit will be made after the 50,000th unit. That will be 50,001 unit. So that's the break-even point in units. Then to calculate the break-even point in shillings, break-even point in shillings, that will be equal to the fixed cost over contribution margin ratio. Contribution margin ratio. So we are going to have it at 5 million minus the contribution margin ratio. How do you calculate the contribution margin ratio? Contribution margin ratio is equal to the selling price minus variable cost. That gives us the contribution. Then we divide by the selling price. So this will be equal to 180 minus 80 over 180. So that will be the contribution margin ratio. So 180 minus 80 is equal to 100. 100 divided by 180. This is equal to, the contribution is 0.5555555. So we divide the 5 million, this gives me 0.55555. So I'm going to divide the 5 million by that ratio. 5 million divide 0.55555. So roughly I'm getting 9 million. When I round off in shillings, this would be 9. That is the contribution margin. I mean the break-even point in shillings. The break-even point in shillings is equal to 9 million shillings. So that is how candidates should calculate the break-even point in shillings and in units. Then the second part of the question reads, look at the question. The number, this is Roman 1, C1, C2, we are to calculate the number of units to be produced to earn a profit of 1.2 million. Number of units to earn a profit of shillings 1.2 million. Now this will be determined, the formula to the number of units. You have to calculate the number of units to earn a profit of 1.2 million. This will be equal to the fixed cost. You remember the formula we gave in our class. This will be equal to the fixed cost plus the target profit. We get the fixed cost plus the target profit. Then we divide by the contribution. We divide by the contribution margin. We divide by the contribution margin. So we know the fixed cost is 5 million. We know the target profit is 1.2 million. This 1.2 million, 1.2 million. We know the contribution margin. Of course, it's supposed to be units. The contribution margin, we had calculated it. Contribution margin is 100. This is the contribution margin, 180 minus 80, which is equal to 1. So this will be equal to 5 million plus 1.2 million, that's 6.2 million. That will be equal to 6.2 million. 6.2 million divided by 100. This is 62,000 units. 62,000. So if the company intends to earn a profit of 1.2 million, then the company must produce 62,000 units. And you can see 62,000 units is greater than the 5,000 units at break-even point. So profit is made at after 1,000 units. At 50,000 units, there is no profit. If the company is to make a profit of 1.2 million, then the company has to produce 62,000 units. That is the meaning. So it's possible to calculate the number of units at a given target profit. So that's it, candidates, for today's lesson. We've answered the question that was tested in August 2024, question 3. On our website, we have provided more questions. Our intention is to answer all questions that have been tested before. If you go to our website, you'll find all these questions I've answered, and we subsequently revise our content to ensure that we capture all present sittings. If you have any questions, please feel free. You can get us directly. We have our numbers online. If you have questions, if you need special attention, please call us, and we are ready to help you pass your exams and to gather knowledge that will be useful as you build your career. Bye-bye.
Let's now talk about number E, or the fifth method of dealing with CVP, where you are uncertain, which is probability tree diagram. Probability tree diagram. So you will allow me to do away with this, your probability tree diagram. Your probability tree diagram, is where you simply draw a tree diagram, almost similar to when you're dealing with probability trees. From your mathematics, you must have done probabilities. So we'll be drawing a similar tree. And for us to be able to draw that or to illustrate that, there are certain items we must be given. One of the items that you must be given is your probability you must be given your who? Probability. And you must be given your variables. You must be given your probabilities and your what? Variables. Your variables here may be labor cost, maybe material cost, maybe direct expenses, variable overheads, maybe the variable cost, maybe the fixed cost, maybe the units to be produced and sold. But they must give you some variable that you're going to represent in your tree diagram so that it can help you to get a what? A decision. For example, if they're asking you to draw a tree diagram to determine your contribution, you know your contribution is the difference between your selling price and your variable cost. So one of the items that they must provide is your selling price. The other item they must provide is your variable cost. They must also provide your what? Quantity sold. If they ask you to represent or to determine profit using probability distribution again, they will give you selling price that they must provide and the probabilities. They must also give you what? Variable cost with the probabilities, the units sold, the fixed cost. So we're saying when you're dealing with a probability tree diagram, there is some certain information you must be done what? Given that is uncertain, and that is why you're going to be drawing a what? A tree diagram. And I want us to look at an illustration on the same, on a tree diagram. And the question I want us to talk about specifically is on April 2024. Let's go to April 2024. April 2024. The question we want to tackle is question 2A. And the company name is what? Joe Mwinzi. That is the name of that company. Joe Mwinzi, the management accountant of Vera Enterprises that makes and sells products alloy, has made the following estimates. You have your sales, you have three conditions, which is the worst, the most likely, and the best. You have your probability of the sales. You also have your variable cost under the conditions that are worst, most likely, and best. You have your costs or variable cost per unit under those conditions, and you also have the probability of variable cost under those conditions. Additional information. The selling price of alloy product is 1,000 per unit. Fixed cost attributable to alloy product is 24 million. Vera Enterprises intends to achieve a target profit of 6 million. Using a probability tree, compute the expected profit of Vera Enterprises. Number 2, compute the probability that Vera Enterprises will fail to break even. Number 3, determine the probability that Vera Enterprises will not achieve the target profit. The target profit. So they're telling us to determine your expected profit using your tree what? Diagram. Remember, from the previous working, we know how do you get expected values? You simply take your variable, you multiply by your what? Probability. So even in this particular circumstance, to get our expected profit, we will take our profit, you multiply by your what? Probability. But you know, how do you determine your profit, class? Your profit, we've talked about it so many times. It is determined by your selling price minus variable cost. You multiply by your units, and then you subtract your what? Fixed cost. You subtract your fixed cost. They are telling us that the selling price is 100. Your variable cost has been provided, and various costs have been provided with various what? Probabilities. So it basically means you are uncertain of the true cost of the variable cost. The units to be sold after production, you have been given under various conditions and they are probabilities. And so this is how you're going to draw this tree diagram. This is how you're going to draw this tree diagram. Let's start by determining the units. There, there, and there. Your units, you have 45,000 units with a probability of 0.3, and those are the worst conditions. That is worst condition. The next condition is when it is most likely. Most likely. And most likely, your probability is 0.6. Then you have the best condition. The best condition, you have a probability of 0.1. Of 0.1. 0.1. How many units are these of most likely? 50,000. And best conditions was how much? 55,000 units. 55,000 what? Units. We have represented the units to be produced and sold. So these are your who? Units. These are your units. The other uncertain item that we don't know about is your variable costs. Your variable what? Costs. And your variable cost, we will have it in 3 market conditions. 3 market conditions. Let's draw it nicely. 3 market conditions. The first market condition is 0.3. Which is what? The worst. So let me write this here, the worst. The worst condition with a probability of 0.3 and your cost is 350. Most likely is the next market condition. With a price with a probability of 0.5, but a cost of how much? 400. You have the best condition with the probability of 0.1 with the price of how much? 550. You repeat this. Worst, your probability is 0.3. Most likely, your probability is 0.55. The best condition, your probability is 0.15. 0.15. Then we also need to analyze what? Worst, 0.3. Most likely, 0.55. The best is 0.15. Your prices are 350, 400, 550, 350, 400, 550. That is your variable who? Costs. These are the units, so these are your variable costs. Very important that you capture that. That is your variable cost there. Okay? Then we can then determine your contribution margin. Your contribution margin multiplied by the units will give us what we refer to as total contribution. Remember, how do you get your contribution margin? it is simply the difference between your selling price, and remember your selling price was set as what? 1,000. Your selling price was set at 1,000. So to get your contribution margin, you simply take your selling price minus your variable cost. And how will that be? You're going to take 1,000 minus 350. 1,000 minus 350. 1,000 minus 350. Let's say 1,000 minus 350. Then you multiply by the units. And how many units were you selling? 45,000. So please confirm that that is 45 million times 650. This is 29 to 50,000. So my values are in thousands. My values are in thousands. Then again, determine your contribution margin by taking your selling price 1,000 minus 400. I believe now you have understood that. Times your units, and your units were 45,000. 1,000 minus 550. How many units again are you selling? 45,000. 1,000 minus 350. Yeah, your selling price is not changing. You multiply by who? Your units now, for the most likely scenario, are 50,000. 1,000 minus 400. Again, your units are 50,000. 1,000 minus 550. You multiply by 50,000. That will give you your contribution. 1,000 minus 350. Your units under the best scenario is selling 55,000. 1,000 minus 400. By who? By 55,000. 1,000 minus 550. By who? By 55. Then we now get our who? Totals. We then now get our who? Totals. We need to get our totals. We get our totals. 600 by 45,000. That must be 27 million. 1,000 minus 550 by 45,000. That must be 20 to 50,000 times 50,000. That must be 32,500. That must be 30 million. 1,000 minus 550 by 50,000. That is 22,500. 1,000 minus 350 times 55,000. 35,750 million. 1,000 minus 400 by 55 is 33 what? Million. 1,000 minus 550 times 55,000. 24,750,000. That will give you your who? Contribution. That will give you your total who? Contribution, which is your contribution margin times your units. Then you then subtract your who? Fixed costs. So let's have our who? Fixed costs. and I will have my fixed cost in thousands of what? Shillings. So you need to indicate that. Your fixed cost, what were they saying? Note number 2. The fixed cost attributable will be how much? 24 million. So this should give you 24,000. 24,000. 24,000. 24 again. 24. 24. 24. 24. And lastly, who? 24. Now with that, we then need to get our who? Profit. Remember, they wanted us to get our what? Expected profit, which we know. For us to get our expected profit, we need to get our profit. We multiply by our probability. So let's start by getting our profit. 29 to 50, which is your contribution, minus your fixed cost of 24 million. This will be 52.50. 27 million minus 24 million. That will give you 3 million. 22.50 minus 24 million. That will give you a negative profit of 37.50. 32,500 minus 24 million. That is 8,500. That is 6 million. 22,500. Is that 1,500? Yes, it is. Minus 24 is 1,500. 35,750. Minus 24 million. That must be 11,750. 33 million minus 24 million. That is 9,000. 9,000 or 9 million. 24,750 minus 24 million. That is how much? 750. We then will introduce our joint probability. Our joint probability, which we simply denote as JPO. Why are we doing that? We are doing that so that we now take our profit by our joint probability to get our expected profit. Our expected profit. Your joint probability will simply take the probability of units, you multiply by the probability of your variable cost. For example, 0.3 by 0.9, 0.3 by 0, it should be 0.3, eh? The other one is what? 0.3. You multiply by who? 0.55. I'm indicating this because it is necessary, so that you together 0.3 by 0.15. Very nice. Must indicate this. 0.6 by 0.3. 0.6 you multiply by who? 0.55. That was 0.6 by 0.55. 0.6 by 0.15. Best 0.1 by 0.3. 0.1 by 0.5. 0.1 by 0.15. Sorry about that. We then get our joint probabilities now. Our joint probabilities. 0.3 by 0.3 is 0.09. Then 0.3 by 0.55 is 0.165. 0.3 times 0.15, 0.045. 0.6 by 0.3, 0.18, 0.6 by 0.55, 0.33, 0.6 by 0.15, 0.09, 0.1 by 0.33, 0.30, 0.03, 0.055, 0.015. Wonderful. Let's then get our expected profits. Our expected profit by taking your probability, you multiply by your who? Profit. Your probability, you multiply by your profit. So 5250, and this was in thousands of shillings. Remember that is in thousands of shillings. 5250 by 0.09. 5250 by 0.09. That is 472.5. 3000 by 0.165, 495. 3750 by 0.045. This will be 168.75. 8500 by 0.18. 1530. It is very, very necessary. As much as it looks exhausting and very involving, you need to do this. 1500 by 0.09. 130. 11750 by who? 0.03. 352.5. 9000. 55. 495. 750 by 0.015. 11.25. Once you've gotten the product of your probabilities and your what? Your profit to determine your expected profit, you then now get your totals. So you must get your what? Totals. And this, remember, is your expected who? Profit. Expected profit. So you now simply add 472.5 plus 495 plus 168 plus 0.75 plus 1530 plus 1980 plus 135 plus 352.5 plus 495 plus 11.25, which will give you 5640. Which will give you 56 what? 40. 5640. So therefore, we can say that, and this was a loss, This was a loss, 22 minus 24, that is a negative profit. The same case with this one. We have left out those negatives. Is there any other negative? That's a profit, a loss, a profit, and a profit. So let's compute this answer again because of the what? Of the negatives, of the negative profits. We left out that, but the good thing is that we have captured it. So let's add again. 472.5 plus 495 minus 168.75 plus 1530 plus 1980 minus, this is a negative, 135 plus 352.5, which was a positive, plus 495 plus 11.25, 5032.5. That will give you your expected what? Profit. That will give you your expected profit. That is the first part of that question. The first part of that question is saying, using a probability tree, compute the expected profit of what? Vera. The next part of that question, part 2, that was part 1. Part 2 of that question, compute the probability that Vera Enterprises will fail to break even. Compute probability that Vera will fail to break even. To break even. The probability that Vera will fail to break even is here. 0.045 plus 0.09. Why? At break-even point, your profit is equal to 0. Okay, so anything less than 0 basically means your company is not able to break even. And as you can see, with a probability of 0.45, your profit is negative. With a probability of 0.09, your profit is negative. So you have not been able to cover your costs. So this will be given by 0.045 plus 0.09. 0.09. It should be 0.045 plus 0.09, 0.135. You're not able to break even from here. The third part of that question, lastly, the last part of that question, determine the probability that Vera Limited will not achieve a target profit. Compute probability that Vera will not achieve. How much is your target profit? Your target profit, they were saying, was 6 million. 6 million. So where will you not be able to achieve your target profit of 6 million? That first is not achieving. You're also not achieving that you have achieved, that you have achieved, that you have not, that you have, that you have, that you have not. So we take the joint probabilities. The first one is 0.09 here. The second one is plus 0.165 here. The third one is already a loss, plus 0.045 plus, that is a profit of more than 6. That is also okay. That is a loss with a probability of 0.09. That is a profit of more than 6 is okay. That is a profit of more than 6 is okay. That is less than 6 million. So 0.045 5. So then what do? We simply now get the total. So for the company not to be able to to achieve a target of what? Of 6 million profit, the probability is 0.405. 0.405. And that is all that is required in that particular question. That is all that is required in that particular question. All right. That is how you deal with probability tree diagram. So as far as your conditions of uncertainty is concerned, in the next lesson, we are going to talk about continuous or normal distribution method. Continuous or normal distribution method. And I would like for us to attempt a question. And from your previous illustration questions, you can attempt November 2017. So your assignment, this is an assignment. This is your homework. This is an assignment. So you can attempt a question of November 2017. November 2017. And the specific question is question 4A. BPO Limited. BPO Limited. BPO Limited. Right. So thank you so much. We can call it a day and then have a good time.
Hello and welcome back to the lesson. Today we are going to discuss mergers and acquisitions in the Kenyan, regional and global context. Mergers and acquisitions in the context, in the Kenyan, regional and global context. These are three things. First, we have the Kenyan context. And Kenya candidates has seen a rise in mergers and acquisitions, which are driven by various factors like economic growth, like market consolidation. And one reason for mergers and acquisitions is increased foreign investment. You understand? Kenyan context. Let's first briefly analyze mergers and acquisition in the Kenyan context. Here in Kenya, we've seen companies merging, we've seen companies acquiring others, and the reason has been because of the economic growth in the country, because of market consolidation. We've had also increase in foreign investments, and there has been mergers and acquisitions in various sectors, various industries. We've seen banks merging, that is the finance sector. We have telecommunications, we have areas to do with the consumer goods and so on. So one reason for the mergers and acquisitions in the Kenyan context is a growing market, because market has been growing. Growth in the general market. Now, in trying to understand mergers and acquisitions in the Kenyan context, you may also need to look at the regulatory framework. The regulatory framework, for example, we have the Competition Authority of Kenya, which plays a crucial role in ensuring fair competition. We also have other regulatory bodies such as the Capital Markets Authority, the Central Bank, and so on. These bodies oversee mergers and acquisitions in the respective sectors. So again, we have regulatory framework. Kenya has put in place regulatory framework that oversee mergers and acquisitions. That's why we've had successful mergers and acquisitions in the Kenyan context. In understanding mergers and acquisitions in the Kenyan context, you may also have to maybe discuss something to do with strategic drivers. Companies pursue mergers and acquisitions to expand their market share, to diversify their operations, and also gain access to new technologies. All right, we have strategic drivers, which I've mentioned. Strategic drivers. Mergers and acquisitions are driven by certain factors. You understand? Mergers and acquisitions in the Kenyan context. Then you have regional context. Mergers and acquisitions in the regional context. And regional context, here we are referring to the East African integration or community. The East Africa community promotes regional integration, leading to increased cross-border mergers and acquisition activities. And Kenyan companies are actively expanding into neighboring countries, and also companies in neighboring countries are also expanding their operations into the Kenyan market. So we have the East Africa integration, East Africa community. We also have COMESA, the common market for Eastern and Southern Africa. COMESA also influences mergers and acquisition activities. COMESA also has regulations that apply to transactions in multiple member states. You understand? Then we have also regional banking expansion. Kenyan banks have been particularly active in regional expansion through mergers and acquisitions. An effort which seeks to tap into the larger Eastern African market. Global context, mergers and acquisitions in global context. Mergers and acquisitions in global context. These mergers are influenced by global trends. Global trends. What do we mean by global trends? Now, the global mergers and acquisition trends influence activities in Kenya and even the region. Factors like technological advancements. We have factors like the economic conditions, the geopolitical events. Such factors play a significant role in mergers and acquisitions in a global context. You understand? So global trends are influenced by technological factors, technological advancements. We have factors like the geopolitical events, which influence mergers and acquisitions in the global context. Economic conditions also play a crucial role. Global economic conditions. You understand? So, apart from what we've discussed, we also have cross-border deals. All right? Cross-border deals. Kenya is increasingly involved in cross-border mergers and acquisitions. Both foreign companies acquiring Kenyan businesses and Kenyan companies acquiring foreign businesses. I've talked about also the technological influences. we have global technological advancements, which are driving mergers and acquisition activities. Companies are merging to gain access to new technologies and also digital platforms. So do you understand, candidates? So that's what we can say about mergers and acquisitions in the Kenyan, regional, and global context. Kenyan, regional, and global context. In this lesson, we've learned that Kenya has seen a rise in mergers and acquisition activities, which are driven by many factors. I've mentioned growing market. Kenya has put in place regulatory framework. We also have certain other strategic drivers where companies pursue mergers to expand market share, to diversify their operations, and also to gain access to new technologies. We've gone ahead to discuss mergers and acquisitions in the regional context. In the regional context, here we are referring to the East Africa Community or East Africa Integration. The East Africa Integration and COMESA. Right? The East Africa Community we know promotes regional integration, which to some extent has led to increase in cross-border mergers and acquisition. We have Kenya companies now operating in Rwanda, others are operating in Uganda. We have banks that have opened branches in Tanzania, and so on. Then we have COMESA also, which promotes regional integration. COMESA, the Common Market for Eastern and Southern Africa. It influences mergers and acquisitions. COMESA has regulations that apply to transactions involving multiple member states. We've seen Kenya banks which have been particularly very active in regional expansion through mergers and acquisitions. You understand? Then we have the mergers and acquisitions in the global context. Global context, we have global trends, which influence activities in Kenya and even the region. Due to factors like technological advancements, we have geopolitical events and economic conditions. All these influence mergers and acquisitions. So candidates, that marks the end of today's lesson. We've briefly discussed mergers and acquisitions in the Kenyan, regional, and global context. Thank you. I'll meet you in another lesson where we continue to share knowledge in advanced financial management. Bye-bye. Hello and welcome to the Manifested e-learning platform. Today we are going to work out an illustrative example on CVP analysis. The example is from the KASNEB past papers. This is the sitting that was done in August 2024. Question 3 has 3 parts, A, B, and C. Part C is the part that we are interested in, but for the sake of revision, we will still solve or answer question A and B. Question A of the question reads, explain the following theories of valuation. 1. Technical theory, 2 marks. 2. Fundamental theory, 2 marks. 3. Random walk theory, 2 marks. That is part A of the question. So let's answer part A, then we'll answer part B, then C, one section at a time. Now, these are 3 theories of valuation of stock. These are stock valuation theories. The first one is technical theory. What do we mean by technical theory? So we are answering August 2024. August theory. Just 2 marks. Technical theory is one of the 3 stock valuation theories. It may also be referred to as technical analysis, and it asserts that stocks value and future price movements can be predicted by analyzing historical market data, primarily the price and volume. That is the technical theory in brief. Of course, here you are just to say that, then you earn the 2 marks. It is stock valuation theory that asserts that a stock's value, the value of a share, and future movements can be predicted by analyzing historical market data. This theory asserts that, what does it assert? It asserts that a stock's value, a stock's or a share's value and price movements can be predicted, by analyzing historical market data. By analyzing historical market, primarily price and volume. Primarily price and volume. By analyzing the historical market prices and volume of stocks or shares, then one can predict the value and price of a share. One can value. Do you understand? Technical analysis. The value of a share and future price movements can be predicted. It's possible to predict what will be the price of a share in future by just analyzing historical market data of the share, primarily analyzing the past price of the share and the past volumes of the share. That is the meaning of technical. And candidates can go further for the sake of understanding this concept and state that it operates on the belief that prices move in trends which repeat over time, reflecting the collective psychological behavior of investors. This theory ignores the intrinsic value, okay, and use tools like charts, moving averages, indicators to identify patterns, to forecast short-term price direction and make trading decisions. So that is a technical theory. 2 marks. Part 2, we have fundamental theory. Fundamental theory. 2. Fundamental theory is another stock valuation theory. Holds that a stock's true value or its intrinsic value is determined by the underlying economic, financial, and management factors of the company. Do you get it? It holds that a stock's true value. It holds that a stock's true value, this theory holds that a stock's or a share's true value, the true value of a share is also known as intrinsic value. This theory holds that a stock's true value or intrinsic value is determined by the underlying number 1, we have economic, financial, and management factors. And management, you don't determine, when dealing with this theory, you don't determine the value of a share by predicting, by studying the past historical market data. No, you look at the underlying economic, financial, and management factors of the company. It involves a deep dive into a company's financial statements, like the income statement, the balance sheet, the cash flow statement, right? Its industry, its competition, and the overall economy. The goal here is to estimate the intrinsic value using methods like the discounted cash flow, and then compare it to the current market price. And if the market price is lower than the intrinsic value, then the stock is considered undervalued and a good buy. You can buy such a share. You go to the fundamentals. You analyze the fundamentals, the balance sheet, the income statement, the cash flow. You look at the economic factors. That's what we mean by financial. Then we have economic factors. You analyze the industry within which the company operates. You analyze the competition and the entire overall economy. By doing so, you'll be estimating the intrinsic value of a share. Then once that is done, when you get that intrinsic value of a share, you then compare that share with the market price of the share or stock. Now, the market price, we know, is determined by the forces of demand and supply. If it is a company that is listed on the stock exchange, then what is listed on the stock exchange, that will be the market price. So that market price is then compared with the intrinsic value. And if the market price is lower, than the intrinsic value, then the stock is considered undervalued and vice versa. And if it is undervalued, then that is the right stock to buy. That's the meaning of fundamental theory. Then we have random walk theory. Number 3, random theory is yet another stock valuation theory. Posits that stock price changes are random and unpredictable. Stock prices. It posits that stock price changes are random. Price changes are random and unpredictable. They are random and unpredictable. They are what? Random, predictable. This theory argues that the current stock price already reflects all the available information, both public and historical, due to the rapid and rational actions of countless investors. And therefore, no form of analysis, neither technical or fundamental, can consistently predict future price movements to gain an abnormal profit. That is to mean that the theory implies that an investor's best strategy is often to hold a diversified, passively managed portfolio. This theory posits that it is not possible to predict the future value of a share, whether you are using the technical analysis method or fundamental method. The stock price changes are random. That means they are not predictable. You understand this? Yes, that is what was required to earn the 2 marks for each part of the question. Technical analysis, 2 marks. Fundamental theory, 2 marks. Random walk theory, 2 marks. Now let's move to the second part of the question. The second part of this question reads that Lima Limited paid a dividend of 15 shillings per share in the last accounting year. The dividends are expected to grow at the rate of 10% for the first 4 years and at the rate of 12% thereafter in perpetuity. The investor's expected rate of return is 15%. Required, determine the intrinsic value of Lima Limited's ordinary share. 6 marks. 6 marks. This is part B. Part B. Part B. Part B, we are required to do what? Determine the intrinsic value of the Lima Limited's ordinary share. Value of the share. That is what we are required to do. Now, to determine the intrinsic value of these share candidates, we will look at the question again. You can see we are told that the dividend, the value of the dividend is 15 shillings. 15 shillings. So, to determine the intrinsic value, we will first of all grow the dividend at 10% for the 4 years. We grow that dividend because we are told the dividend will be growing. Okay. After growing this dividend for the 4 years, we then discount the dividends by multiplying the value of the dividend with the present value interest factor at 15% and the number of periods. We will discount, then get the present value. Then we are going to get the sum of the discounted values. That is what we are going to do in order to determine the intrinsic value. Then at the end of the 4th year, we know that we will also do a discounting. So we have this table, but we are going to have a table. Column 2, we have dividend. So for example, year 1, look at the question. Year 1, that dividend of 15 shillings will grow at 10%. So we are going to multiply this 15 by 1.1. We raise to 1. Value of this dividend at the end of year 1. Then at the end of year 2, we'll again multiply 15, 1.12. Year 3, it will be 15, 1.1, we raise to 3. Year 4, 15 into 1.1 raised to 4. So these will be the values of the dividends for the 4 years. We are growing it. 1.1 means candidates. It will grow at 10%. That will be 100% plus 10%, which means that will be equal to 110%. If you are to convert 110% into decimal, it will be 100. It will be 110 over 100, which is equal to 1.1. That's how I get 1.1. It is 110%. It is growing by 10%. So it will be 100% plus 10%, giving us 110%, which we convert into decimal to get 1.1%. Then that's how you grow it. So I'll take my calculator and grow the dividend. That will be 15 times 1.1. I'm getting here 16.5. Then I have 15 times 1.1 raised to 2. 18.15. Then I have 15 times 1.1 raised to 3. This is 19.965. Then lastly I have 15 times 1.1 raised to 4. 21.9615. 21.9615. This is These are dividends. Then we multiply these values with the present value interest factor at 15%. The values here, the present value interest factors, we read directly from the table. The present value table. If you look at the present value table, at 15%, 1 year. Period is 1 year. It gives you 0.8696. Now, if you don't have a table, then there's an alternative way of getting the interest factor. There's an alternative way of getting this interest factor. Okay? If you don't have a table, that will be 1 over 1.15 raised to 1. So that will be 1 divided by 1.15. Yes, 8696. This is how you get it. Then for year 2, it will be, if you are not using the table, this is how to determine the present value interest factors. For year 2, it's going to be 1 over 1.15 raised to 2. Okay, so that will be 1 divided by 1.15 raised to 2. 7561. This is 0.7561. Then just reading from the table, I will give you an alternative way candidates, but this can be read directly from the table. If you are in the exam room, you don't have it this way. Unless you are given a rate that cannot be read from the table, then you use this formula. But for the purposes of exam and time management, you don't have to go this long route. Just read directly from the table. You can read the present value interest factors directly from the table. Third year read from the table is 0.6575. 0.6575. Then year 3, year 4, 0.5718. Are you following, candidates? Yes. So these are the present value interest factors. Then you recall, candidates, in year 4, again, in year 4, apart from this dividend growing, this dividend, we also need to discount the value of the dividend P0. To get the value of P0, we know this is equal to D0 at year 4 into 1 plus G over KE minus G. So our P0 here will be equal to D0. D0 is the 21. This will be 21.9615. We grow it at 1.1, 1 plus G. The growth rate. We have the growth rate from the question. Do we have the growth rate? Do we have G, the growth rate? Do we have the growth rate? Look at the question again. Look at the question. Are we given the growth rate? The growth rate. We have the growth rate. Yes, we are told. Look at the question. We are told that the dividends are expected to grow at the rate of 10% for the first 4 years. So we have grown this dividend. Look at the board. We've grown this dividend for the first 4 years. Then after 4 years, we read, and the rate of 12% thereafter. After growing this dividend at 10%, thereafter it will be growing at the rate of 12% in perpetuity. So it's going to be 1.12 and not 1.1. Okay, so it's growing at that rate. So we divide by KE. KE is the cost of equity, which is 15%. 15% converted into decimal will be 0.15. Then the growth rate of 12% converted into decimal will be 0.12. Are you following, candidates? Yes. So there are two growth rates, 10%, 12%. The first 4 years, 10%. The last year, 12%. So that will give us the value of this dividend, P naught. So we go to the machine, calculator, get the calculator, punch in these figures. Punch in the figures. What are we getting? This is 21.96 into 1.12 divide by 0.15 minus 0.12. This is equal to 819.896. So the discounting, because it's 4 years, the discounting factor is going to be 0.5718. So that's it. So the last column here is to calculate the present value. Then after calculating the present value at each period, we get the total here. That will be the value of this dividend. So we multiply the present value interest factor with the dividend to get the present value. This is called discounting, because this 16.50 is the value of the dividend after 1 year. This is the future value. To determine the present value, we multiply it with the present value interest factor. So year 1 is 16.5 times 0.8696. This is equal to 14.3484. 14.3484. Year 2, we multiply 18.15 times 0.7561. Give us, this is 13, these are many, this is 13.723215. Next we have 19.965 times 0.6575. This will be equal to 13.1269.875. Then we have 21.9615 times 0.5718. 12.5575857. Then lastly we multiply 819.896 times 0.5718. This gives me 5328. So with that, we have all the present values. So we sum all the present values to get the value of this dividend. So we're going to get the intrinsic value here by adding all these present values. So this gives me 52 522.816. This is 0.57, there are many decimals, 5727. So this is the intrinsic value. That is how to determine the intrinsic value of a share. So the intrinsic value is equal to shillings 522 and 60 cents. That is intrinsic value. That is the intrinsic value. So that is the intrinsic value. And that is part B of the question, August 2024, question 3. Now allow me to move to the next part of the question, which is on CVP. CVP. Let's move to the next part of the question. Part C of the question reads, Tinga Limited manufactures and sells a single product named T140. The following information relates to the product. Selling price per unit is 180. Variable cost per unit is 80 shillings. Fixed cost per annum 5 million. Required Roman 1, break-even point in shillings and in units for marks. Roman 2, the total number of units, the number of units to be produced to earn a profit of 1.2 million. That is the question. We need to calculate, first of all, the break-even point in units, then the break-even point in shillings. So this is part C. We are to calculate the break-even point in units. To calculate the break-even point in units, we know the formula is fixed cost over contribution margin. Just fixed cost over contribution margin. So what is the fixed cost in this question? 5 million. The fixed cost here is 5 million shillings. What is the contribution margin? We know the contribution is equal to selling price minus variable cost. Contribution margin is equal to selling price minus variable cost. The selling price here is 180. The variable cost from the question is 80. So that will give us the break-even point in units. This will be equal to 5 million divide 180 minus 80 is just 100. Just 100. This is equal to 50,000 units. Now this is the break-even point in units. That means that if the company is to produce 50,000 units, the company will not make any profit, because at break-even point, profit is equal to 0, which means that the total cost equal the total revenue. At break-even point, total revenue is equal to total cost, and we know profit is equal to total revenue minus total cost. So total profit is equal to revenue minus the cost, which will be equal to 0. If the company produces 50,000 units, there is no profit at this point. This is the break-even point. The first shilling of profit will be made after the 50,000th unit. That will be 50,001 units. So that's the break-even point in units. Then to calculate the break-even point in shillings, break-even point shillings, that will be equal to the fixed cost over contribution margin ratio. contribution margin ratio. So we are going to have it at 5 million minus the contribution margin ratio. How do you calculate the contribution margin ratio? Contribution margin ratio is equal to the selling price minus variable cost. That gives us the contribution. Then we divide by the selling price. So this will be equal to 180 minus 80 over 180. So that will be the contribution margin ratio. So 180 minus 80 is equal to 100. 100 divided by 180. This is equal to, the contribution is 0.55555. So we divide the 5 million. This gives me 0.55555. So I'm going to divide the 5 million by that ratio. 5 million divide 0.55555. So roughly I'm getting 9 million. When I round off in shillings, this will be 9. That is the contribution margin. I mean the break-even point in shillings. The break-even point in shillings is equal to 9 million shillings. So that is how candidates to calculate the break-even point in shillings and in units. Then the second part of the question reads, look at the question. The number, this is Roman 1, C1, C2, we are to calculate the number of units to be produced to earn a profit of 1.2 million. Number of units to earn a profit of shillings 1.2 million. Now this will be determined, the formula to the number of units. You have to calculate the number of units to earn a profit of 1.2 million. This will be equal to the fixed cost. You remember the formula we gave in our class. This will be equal to the fixed cost plus the target profit. We get the fixed cost plus the target profit. Then we divide by the contribution. We divide by the contribution margin. We divide by the contribution margin. So we know the fixed cost is 5 million. We know the target profit is 1.2 million. This 1.2 million, 1.2 million. We know the contribution margin. Of course, it's supposed to be units. The contribution margin, we had calculated it. Contribution margin is 100. This is the contribution margin, 180 minus 80, which is equal to 1. So this will be equal to 5 million plus 1.2 million, that's 6.2 million. That will be equal to 6.2 million. 6.2 million divided by 100. This is 62,000 units. 62,000. So if the company intends to earn a profit of 1.2 million, then the company must produce 62,000 units. And you can see 62,000 units is greater than the 5,000 units at break-even point. So profit is made after 1,000 units. At 50,000 units, there is no profit. If the company is to make a profit of 1.2 million, then the company has to produce 62,000 units. That is the meaning. So it's possible to calculate the number of units at a given target profit. So that's it, candidates, for today's lesson. We've answered the question that was tested in August 2024, question 3. On our website, we have provided more questions. Our intention is to answer all questions that have been tested before. If you go to our website, you'll find all these questions I've answered, and we subsequently revise our content to ensure that we capture all present sittings. If you have any questions, please feel free. You can get us directly. We have our numbers online. If you have questions, if you need special attention, please call us, and we are ready to help you pass your exams and to gather knowledge that will be useful as you build your career. Bye-bye. Hello candidates, and welcome to the Advanced Financial Management Learning session. The topic is mergers and acquisitions. In our today's lesson, we're going to discuss the regulatory framework for mergers and acquisitions. Regulatory framework for mergers and acquisitions. And in this lesson, we're going to highlight some of the regulatory bodies and legislation govern mergers and acquisitions in Kenya. And the regulatory framework for mergers and acquisitions in Kenya is designed to ensure fair competition and also to protect the interests of various stakeholders, where companies choose to merge or when a company decides to acquire another one. That decision is likely to affect many stakeholders like the employees, the management, the shareholders, the investors, the members of the public, and so on. And therefore, it's important that these transactions are regulated. That's why we have regulatory bodies in Kenya that help in ensuring that the interests of the various stakeholders are protected. So the first regulatory body is the Competition Authority of Kenya. One, Competition Authority of Kenya. The Competition Authority of Kenya is the primary regulatory body that is responsible for overseeing mergers and acquisition activities in Kenya. And the mandate of the CAK is derived from the Competition Act. It is derived from the Competition Act. This is an act of parliament that stipulates that there ought to be a Competition Authority of Kenya, which has been put in place since the year 2010. It is the principal legislation governing mergers and acquisitions, right? The Competition Authority of Kenya. It is the principal governing body. And the role of the Competition Authority of Kenya is to prevent anti-competitive practices that may arise from mergers and acquisitions. Do you understand? That is the primary role of the CAK. Is to do what? Is to prevent anti-competitive practices that may arise during these transactions, the mergers and acquisition. The second body is the Market Authority. Capital